Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, August 17th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So to frame things for you right out of the gate, there are really four critical themes emerging from today's proprietary updates.
Right, starting with a massive global rates repricing. This is pushing the 30-year Treasury yield up to 5.31%.
Which is, the highest level we've seen since 2007.
Yeah. And second, we are tracking a stark equity bifurcation. We're seeing this aggressive, relentless buying in AI hardware.
And it's completely masking deep underlying weakness in rate-sensitive sectors and software.
Third, there is a severe geopolitical squeeze in the commodities market, pushing Brent crude oil definitively above $90 a barrel.
And finally, the fourth theme, our proprietary card data is showing a severe, unprecedented 11-week slide in United States discretionary spending velocity.
Moving to today's data, let's unpack that first theme, because the macroeconomic picture is really being dominated by a dramatic bear steepener in the yield curve.
Yeah, it's heavily concentrated in a long-end rate shock. Looking at our daily desk data, the 30-year Treasury breached 5.31%.
Which jumped 4.7 basis points today alone.
Right, while the front-end 2-year remained relatively flat. That bear steepener is unquestionably the defining feature of the session.
Because when the long end of the curve rises faster than the short end, it tells us the market is demanding significantly more compensation for holding long-term risk.
Accurate. And looking at today's updates, there are three distinct drivers behind this specific move. First, stalled Iran war negotiations are forcing the market to price a heavy inflation risk premium back into energy.
Okay, and the second driver?
Second, we are witnessing a global rate repricing happening entirely independent of the Federal Reserve. Dealer desks note that Japan, Canada, and the Eurozone are all pricing in faster tightening than the United States.
I want to pause on that second driver for a second. If Japan or the Eurozone start pricing in faster tightening, their domestic bond yields rise.
Right.
Which naturally means global capital flows back to those regions because the relative yield advantage of United States Treasuries diminishes.
Precisely. It is a competition for global liquidity. The United States is being forced to offer higher yields just to maintain its current funding base.
And that connects directly to the third driver, which is structural.
Yeah, today's proprietary updates highlight a massive supply shock in the primary credit market. We saw 12 investment-grade companies issue $9.1 billion in debt in a single trading session.
Let's trace the plumbing on that for a second. For the non-professional investor listening, how does $9.1 billion in new corporate debt automatically force the 30-year government yield higher?
So it comes down to hedging. When underwriters take on a massive flood of new corporate bonds, they hold the immediate risk that interest rates might rise before those bonds are distributed.
Right. So if rates rise, the value of the bonds drops and they take a massive loss.
Exactly. To hedge that specific risk, dealers mechanically short long-dated Treasury futures. When you have $9.1 billion hitting the market in a few hours, that requires a massive volume of shorting.
Which drives the price of those Treasuries down.
And mathematically forces the yields up. So the spike we saw today to 5.31% is fundamentally a supply-driven rate move. It's the mechanics of absorption, not just an inflation break-even move.
Understood. But that supply-driven mechanic is now colliding head-on with some very hawkish economic data.
Yeah, the Empire Manufacturing Index.
Right, it surged to 20.6 today. That is a massive regional beat. But if we look under the hood of that report, it signaled re-accelerating prices paid for inputs.
Which is a huge problem for the Fed.
Because it threatens the broader disinflation narrative they've been relying on. Consequently, we saw the market slash the probability of a September rate cut from roughly 75% down to roughly 35% today.
Undeniably. We are watching the market actively reprice the entire trajectory of monetary policy in real time.
Pivoting to the equity markets, you'd think that a historic spike in yields would broadly crush the stock market today, but we are actually seeing the exact opposite in a very specific, isolated sector.
Yeah, the concentration is extreme right now.
The S&P 500 closed down 0.52% at 7,745 today, but the equal weight S&P 500, the RSP, fell much harder. It closed down 0.89%.
That widening gap is the defining characteristic of this tape. Looking at our latest run, there was an unmistakable, aggressive surge in AI infrastructure.
Entirely ignoring the broader down tape.
Right. We saw semiconductor and optical networking stocks jump anywhere from 5 to nearly 9% today. SanDisk, ticker SNDK, closed up 8.88%.
Wow. That's a massive jump in this environment.
Yeah, and Coherent, ticker COHR, was up 7.79%, and Applied Materials, ticker AN, at 5.55%. The market is aggressively hoarding semiconductor capital equipment and storage.
But when you look outside of that AI infrastructure bubble, the damage is severe, particularly in rate-sensitive and consumer-exposed names. Carvana, ticker CVNA, dropped 7.28%.
We also saw heavy, sustained selling in ServiceNow, ticker NOW, and KKR.
Which brings us to the flows and positioning data. Institutional consensus shows hedge funds buying global equities for a third consecutive week.
They are still allocating capital, but they are actively rotating out of software and heavily into semiconductors.
Affirmative. And the structural fragility underneath this rotation is deeply concerning. Commodity trading advisors, or CTAs, are currently heavily long equities.
And because CTAs trade systematically based on momentum and volatility triggers, they are vulnerable to a massive mechanical sell-off if the S&P 500 drops below the 7,717 downside flip level.
Let's clarify the mechanics of that 7,717 flip level for a moment.
Yeah.
This comes down to the options market and dealer positioning, right?
Correct. If the index breaks below that specific threshold, options market makers who sold put options suddenly see their risk exposure turn negative.
So to remain market neutral, those dealers have to aggressively short S&P futures to hedge their books.
Which creates a snowball effect of selling pressure. That dynamic is known as short gamma.
On that point, let's look at the fundamental data underneath the market, which is deteriorating rapidly. Bringing in today's proprietary card data, the United States consumer is cracking.
Yeah, and it is the specific shape of the decline that matters here. Discretionary spending velocity is down 6.6% year over year.
But more importantly, this is an 11-week relentless, unbroken slide.
The persistence of that decline is the true signal. Statistical noise gives you volatile blips like a down week followed by an up week.
Right.
But a monotonic 11-week contraction without a single positive interruption indicates a structural shift in household cash flow.
It suggests consumers have fully exhausted their excess savings or hit their credit limits.
And this kind of persistent contraction shows up in our high-frequency card data long before it reaches the payrolls and confidence surveys the broader market relies on.
And the timing here is critical because retail earnings start tomorrow with Home Depot, ticker HD, followed later in the week by Walmart, ticker WMT, and Target, ticker TGT. Which raises a fundamental contradiction I want to explore. If our desk data shows the consumer falling off an 11-week cliff, why is institutional consensus still actively buying global equities?
It's a great question.
If the primary engine of the United States economy is stalling out, why are hedge funds net buyers?
Because the specific equities they are buying have completely decoupled from the consumer. Large cap tech and AI infrastructure names are acting as the market's shock absorbers.
So they're just completely insulated.
Yeah, they have entirely disconnected from traditional discount rate mechanics and consumer health. Right now, companies like SanDisk and Applied Materials are trading strictly on corporate capital expenditure and massive data center buildouts.
And the buyers of those data centers are not average retail consumers swiping a credit card.
Exactly.
They are the mega cap technology monopolies with fortified balance sheets.
Noted. Institutional money is hiding in the few sectors where revenue streams are effectively insulated from the retail spending cliff. They're treating AI hardware as a defensive asset class against a consumer recession.
Looking at where else capital is hiding today, the geopolitical risk premium is aggressively returning to the tape. Looking at our latest run, Brent crude settled at $91.11 per barrel.
Up 2.58%, firmly crossing that critical $90 threshold. And WTI crude jumped 3.0% to $84.95.
And we really have to frame this crude rally strictly around the day's catalysts. This is not a demand-driven oil rally signaling robust economic growth.
Not at all. This is entirely tied to the Iran war talks, appearing to be at a complete standstill, combined with heightened, aggressive rhetoric regarding Oman.
So the market is pricing in the rising probability of a physical supply disruption in a major transit choke point.
Which forces a geopolitical risk premium directly into the spot price.
We also saw gold, ticker GCA, rally to $4,473, up 0.93% on the session. It's acting as a dual safe haven against geopolitical uncertainty and a structural hedge against the inflation risk that comes with $90 oil.
But the most aggressive commodity move today was in industrial metals. The London Metal Exchange copper market saw an intense squeeze today, up 1.7% intraday.
Yeah, featuring severe backwardation and carrying a $545 per metric ton spot premium.
That copper premium is a vital metric to unpack. Backwardation occurs when the current physical spot price of a commodity is trading significantly higher than the futures price.
Which is unusual because normally futures are priced higher to account for the costs of storage and interest over time.
Right, so when the spot price flips and trades at a massive premium, it implies a desperate, immediate need for physical supply. Buyers are willing to pay a $545 penalty just to secure the physical metal today, rather than waiting for future delivery.
I was staring at the copper tape this morning, and it honestly looked like a typo. A $545 spot premium is wild. What is driving such severe backwardation? Is this a signal of a sudden industrial demand boom or something more structural? Because it feels exactly like a run on a grocery store before a hurricane. People are not suddenly consuming more food. They are just aggressively hoarding it before the supply chain gets cut off.
That behavioral mechanism is exactly what is happening in the copper market. This squeeze is not driven by a sudden organic economic boom. It is being driven by United States tariff front-running. Buyers are scrambling to secure physical supply and get it into warehouses before anticipated import tariffs hit.
Because if you believe a 20% tariff is coming next month, paying a massive spot premium today is actually the cheaper economic option.
Concur.
Yep.
That panic to secure physical inventory right now is distorting the physical market versus the futures curve. It is a supply chain distortion, pure and simple.
So let's bring all of these distinct cross-currents together to synthesize the current market regime. We have a 30-year yield at a 19-year high of 5.31%.
We have Brent crude oil trading above $90 a barrel.
And we have an 11-week unbroken slide in consumer discretionary spending. Yet, simultaneously, specific AI hardware equities continue to soar, pushing cap-weighted indices higher and keeping volatility artificially compressed.
When you connect those simultaneous moves across rates, equities, and commodities, it points directly to a highly bifurcated, stagflationary tail environment.
Meaning the market is beginning to price a very narrow, very dangerous scenario.
Yeah. Historically, if consumer spending fell off a cliff for 11 weeks, the Federal Reserve would aggressively step in and cut rates to stimulate the economy.
But right now, the geopolitical squeeze pushing oil above $90, combined with the copper tariff front-running.
And the re-accelerating prices paid in the Empire manufacturing data.
Right. All of that is creating imported, supply-driven inflation. They are essentially trapped by the commodity board and the supply chain.
The Fed cannot cut rates to save a slowing consumer because that oil-driven inflation is tying their hands.
And that is why the global rate repricing we discussed earlier is so critical. Central banks in Japan, Canada, and the Eurozone are already adjusting to this reality, forcing global yields higher.
Exactly. And the equity market's solution to this stagflationary trap has been to simply abandon the rate-sensitive sectors like real estate, consumer discretionary, and financials, and crowd entirely into AI infrastructure.
The structural bet is that corporate spending on artificial intelligence will outlast a consumer recession.
And remain immune to a 5.31% 30-year yield.
Which leaves us with a rigorous analytical question to consider before tomorrow's opening bell. If the broader market is currently relying exclusively on a handful of AI hardware stocks to act as shock absorbers, taking on the entirety of a historic rate shock, geopolitical commodity spikes, and a consumer cliff.
Well, wait, what happens to the broader indices and those fragile CTA positioning levels if that isolated growth engine even slightly misses earnings expectations at the end of the month?
It's a huge risk.
To quickly recap today's briefing, rates hit cycle highs today, driven by massive corporate supply mechanics and oil-fueled inflation fears.
In the equity markets, a surge in AI infrastructure completely masked a severe consumer-driven sell-off across the broader tape.
And in commodities, geopolitics and tariff front-running violently squeezed both the energy sector and industrial metals into backwardation.
Thank you for listening to Market Pulse by Orestes Capital, where Elena and Marcus will be back tomorrow with the latest market color. Have a good week.